Hello guys, please tell me whether you can see see and hear my voice. Could you please all confirm you can see my screen and listen my voice? Okay, so that's great. Okay, so let's start. And the topic of today is advanced fundamental analysis, right? So what I'm gonna do, I'm gonna refresh you for 10 to 15 minutes about what we learned so far in our course about the fundamental analysis. Just refresh it, and then I'll ask if you have some of your companies to analyze. I'll do the analysis of those companies, or otherwise we're gonna study and do some analysis of our own of any random companies, right? Okay, so let's start. What we have seen, what is fundamental analysis? It's basically the study of the balance sheet. And while understanding the fundamental analysis, you need to know what is EPS, which is earnings per share, what is P ratio, what is PEG ratio, and what is the qualitative and the quantitative aspects of a company. So what was the EPS? EPS is the earnings per share, the portion of the company's profit allocated for each share in a public market. EPS, it's an indicator of company's profitability. And how EPS can be calculated? It's the net income of any company minus dividends, if that particular company has given any dividends, divided by total number of outstanding shares in the market. So that is EPS. And remember, EPS, it's the rational price, right? What is P ratio? Earnings ratio. It is a ratio of company's current market price or the current share price divided by its EPS, means its per share earnings. So the P ratio can be calculated but is equal to the market price divided by the earnings per share. So if in a company which has a high P, it suggests that investors are expecting a very high growth in future compared to the companies with lower P. The companies who are having lower P, investors have a little expectations, and on the higher side, the companies who have higher P, they have very high expectations that the earnings per share or the profits, basically what they are supposed to make in that company, it's tremendously big. Now the third ratio, it's the PEG ratio, and the PEG ratio is calculated by your PE ratio. And how P ratio can be calculated? Market price by EPS, and the PEG ratio is P ratio by EPS. So it's very easy. I'm just refreshing it. EPS is equal to net income minus dividend divided by total outstanding shares. PEG ratio, it's P ratio by EPS. And what is P ratio? Market price by EPS, right? So for the PEG, if the PEG is so small, the more the stock, it's undervalued as per its earning performance. So what is P ratio? P ratio is the momentum and PEG ratio is the acceleration. If PEG is between 0 and 1, then the company is supposed to be undervalued and good for the investment on the long side. And if the PEG ratio is between 1 and 2, then it is fairly valued. And if PEG ratio is above 2, then the particular company is highly overvalued. And if the PEG ratio is less than 0, then essentially the company is making losses. So P ratio, it's the emotional price, what people are expecting from that particular company to deliver. And EPS, it's the rational price, the actual performance of that company. Book value, it's the inheriting price of the company, means its asset, its instruments, its land cost. If you sell a particular company, so whatever be the value of that company on the book level. And book value, say 3 to 4 or say up to 5, it's also a good ratio between book value and the market price. Right, so this is all, it's just the mm, a quick refresher about what we have learned so far. So now let's go back to, could anyone tell me which is the site where we go and do all of our fundamental analysis? Tell me, guys, fast, fast. Screener, correct, Amarjeet. Yes, excellent. Okay, so let's go back to our site where we're gonna do our analysis. So this is a screener, but before going to the screener, let's characterize or define what we have, what we needs to look in the screener, right? So if I go to the Excel quickly, I'll just increase the font size so that we can see better. So the first thing, book value. Should not book, what is the ratio between the book value and the market price? Anyone can tell me? It should be the ratio between the book value and the market price should be 1 is to 5 at the max. Means whatever be the book value, it's the ratio should be 5, not in percentage. Okay. And what is our EPS? Should be greater than 20, right? And what is our PEG ratio? PEG ratio should be between 0 and 1. What is our debt to equity? Should be less than 1. What should be our interest coverage ratio? Should be greater than 3. And company should have an increasing EPS. There should not be any pledged share. That share is equal to 0. Right? So this is of our 6 to 7 conditions on which we gonna analyze our stocks or any particular company fundamentally, right? So everybody is okay with this? Everybody understands what I have written so far? Do you have any question on this? Okay, so let's proceed to the screen. So this is the website which we're gonna use for all of our fundamental analysis, right? Here it's a very easy thing for all of you actually to join. Hmm? As I have logged in here, it's very easy. You can just simply log in. So let's first try to analyze few companies. Do any of you have any of the companies for the analysis? Please give me the name of any company where we do all of our fundamental analysis. Any special company on which you would like to see? India Bulls. So let's see India Bulls Venture. India Bulls Ventures Limited. Hmm. Yeah. So this is your company, Amarjit, right? So if you see the ratio between the book value and the current price, it's approximately 20 times, right? So, but let's see some more, huh? And the people are expecting the P of 88%. Means people are expecting for it to grow 88% per year. Debt to equity, it's greater than 1, which is 3.39. And interest coverage ratio, it's less than 3. So from all of our analysis, this looks not a promising thing to me, but let's see how its EPS is doing. You see, promoter holding is low, and what we have seen, it's trading roughly 23.55 times to its book value. But let's see how its EPS is going. So if I go to approximately 3 years or 4 years, so 2, 3, 5, 2.5, 319. So what at how much rate it is growing actually? If we consider from March 2013 to March 27, how much it has grown? Fast guys, how much it has grown? From 2.24 to 3.19. Anyways, so it's roughly growing around 50% in a year, and the investor are expecting 88%. And looking at this, I'm not very happy to invest on this company, first of all. And now let's see few other things, like how it's their sales. Sales are increasing, but accordingly, the expenses are increasing as well. And the operating profits 64, 52, 51, 40, and this has been increased, but eventually here the things that this is going on a natural pace. And expense operating profits annually 257, 235, 212, 226. So more or less okay. Means this company is doing okay. And let me see if they have any pledge percentage, none. They don't have any, and the EPS is 2.9. So let's have a look on the website. Company website, it's showing the money control. Okay, let's see on a Google. So is they are dealing with some kind of stocks and all those equity trading? Is the company, Amarjit? Is the correct company, Amarjit? India Bulls. Yes, it is. It is. Yes, it is. It is one of the capital market companies providing securities, commodities, and the currency broking services. So this is the same at what we have seen in the previous. So this is exactly the same thing. But essentially, this one is right, and also this one is as well. This one is the actual website, and that one is the group company's website. So it's I don't think Amarjit, you should go anywhere into this as per its fundamentals and as per its business model. A strict no, because first of all, look, if we are doing fundamental analysis of the company, then we don't need to look from the positive aspects that if we see two three things in our favor, we should go for it. While doing the fundamental analysis, you have to look for a very tight scrutiny of any particular company. You need to have an approach to find out the reasons to reject it. And once the companies whom you don't reject, in spite of trying hard to reject, those companies you should go further ahead. So this is the company, a big no. Let me have some other companies of any one of yous whom you want to do some analysis. Nikhil, put the your any of your message on the attendee charts. Attendee chats where we are going to have conversation. So if you have anything to ask, please put them onto the attendees chat because I can't see any of your questions where you are putting. Okay, so let's see UltraTech. I'll be showing, say, 7 to 8 companies as per the analysis, and then afterwards, I will ask you guys to tell me whether I should have to buy this company or not, right? So let's see the UltraTech. UltraTech Cement Limited. The ratio between the book value and the current price is quite big, but it's a cement and cement product company, so that can be understandable. The people are expecting roughly 42% growth from this company as per stock P. And look at the PEG ratio, 15.98. It is highly overvalued company as per its current price. Debt to equity, it's very fine. Interest coverage ratio, also it's very fine, right? But this company is very much overvalued as per its all other fundamentals. And this has delivered a poor growth of this 5 years, low return on equity. It is not paying out dividend. That's fine, because you look, people prefer the companies who pay the dividends, but I prefer the companies who don't pay the dividends and put that money into their growth, so that they have a rising EPS and they could give us more profits in terms of the earning. So let's see, first the annual results, the EPS and EPS, whether they have a rising EPS. So if I go, say, 3 quarter 2014, 76, 71, 86, 95. So roughly how much this has grown? Say 25 to 30%. And how people are expecting? Okay. Means roughly the growth is 30%, and the people are expecting the 41% growth. So that should be okay. And okay with the interest coverage ratio. I'm okay with the debt to equity, but I'm not okay with this PAG ratio, because it's a very much overvalued company. Because the problem with the overvalued company is, whenever the market corrects or the market do some kind of retracements, they heavily correct. So this is an okay company, but I'm not investing or putting it into my portfolio. Why? Because of its PEG. It is very much overvalued. And we are looking for the companies on a fundamental basis for our portfolio which are undervalued, or the companies in which we can initiate our long trades. So, but it doesn't mean that if that is overvalued, you go and short that company, right? It's not like that. The only thing is, this type of company corrects more when the market moves downwards. Okay. So is there anything else, Gaurav, for UltraTech? Okay. So Ashish has asked for PTA. What is full form of PTA? Because I can't get anything from PTA. Could you give me the full form? Ashish, Nikhil, PTC India. Okay. PTC India Financial Services. Okay. So the current price and the book value, it's almost the same. So needs to investigate what is the reason why the current price is close to the book value. Ideally, it should be, current price should be in a range of 3 to 5. Anyways, stock P is 7. So people are expecting 7% growth from this stock. PEG ratio is good, 0.43. So, and debt to equity, it's a bit more on a higher side. It's actually quite higher side. That's explain why actually this book value and the current price have the same. And the interest coverage ratio is also less than 3, right? So that is the reason, understand, we have started with the problem why this is the same, and we get the answer from here and here. Because debt to equity, it's greater than 1. It's 3 actually. Ideally, it should be, means the company is investing most of its profits by paying the loans and all the other things which they have taken from some other borrowers. And interest coverage ratio, it's less than 3, means the company has a tremendous pressure for its interest, right? Let's see some other thing. So people are expecting the 7% return from it. And let's see, and go have a look on the EPS. 3.5, 2.6, 6.7, 5.38. The EPS is quite good. The company is providing the good earnings per share, but I'm not very much comfortable with its overall performance, right? So, as I said, we need to find out the reasons to reject. And we have more than 3,000, 4,000 companies to analyze. So, why should we go for a few companies whom we have certain kind of doubt? So, in this case, three things are in our favor, but four things are not matching into our criteria. So, Nikhil, would you like to invest in that company? Right? Yes, Nikhil. So that's what means what we are trying to do. If we are putting our hard earned money into the companies, then it should satisfy at least 6 points out of 7. In one point we can say okay, but if we find out the company, then I'll tell you what is the rest of the processes afterwards. Here we just need to accept or reject any company within 10 minutes, right? It's we don't have to invest 10 minutes for a one particular company, right? So that should be our approach. Amarjit asked for Yes Bank, so let's see Yes Bank. Yes Bank. Book value and the current price. Yeah, indeed. Because you know what? People expect a few things some news or anything. But if you see the overall performance of the company and that those key numbers which I have told you, that actually describes whether this company could be profitable in future or not. So we have narrowed down our fundamental analysis to the key points. And if we have narrowed down our fundamental analysis to the key points, then we gonna stick with them. Okay, great, Nikhil. So let's, Amarjit, let's see Yes Bank. So book value is 500, current price is 1839, very much okay. Stock P is say 24%. People are expecting 24% for it to grow. PEG ratio, it's a little bit on the higher side, right? 0.86. And ideally, I am very much happy to have the companies who have PEG ratio 0.5. But anyways, debt to equity, this is not good. 8.23. And ideally, it needs to be less than 1. Interest coverage ratio, that is also not good. You know what? Why these two figures are very good for Yes Bank before it's this price? When I have started analyzing Yes Bank, I have estimated the fair value of the Yes Banks to be something around 1500. And as soon as it has crossed its fair value, which is 1500, then you see its PEG has been increased, and accordingly their liability, this debt to equity, has been increased, and the interest coverage ratio has been decreased. So right now it's not a good time to invest in Yes Bank. When it corrects and go to the level of something around 14 and the 1500, then we could think of investing in Yes Bank once again. Not at this moment, but this we can put into our watch list for further analysis here, right? And let's have a final look on the EPS. EPS is increasing, and that's what it explains the price of this. You know, in actually since last 1 year, if you see the EPS, every company EPS has been increased. So if you just look on one single parameter, then you have a messy picture. like you see, okay, that this company has been going from 1500 to 1800, so there must be something going on. But that's okay, because we are in the bull market for last 1 year. No major correction, no retracement or something like that. So we are actually approaching to a bubble, and when this bubble bursts, then it's going to be quite a panic situation. And for us, being as a professional, we should analyze all the things in a professional way. We know that we need to see each and every aspects of the company, not just the price, or the price that it has grown from there. So Amarjit, this is the thing which you can have on your watch list. But for current situation, I'm not preferring Yes Bank to have in our portfolio. Yes, of course, Satya, because there are many stocks basically in mid caps which are really undervalued. And that's what we're gonna find from our fundamental analysis. The stocks which are still undervalued, which nobody has think of, we analyze them fundamentally, we see all their aspects, and that's what we're gonna be profitable. Otherwise, the things which have already grown, what is the point in analyzing them? So that's what we needs to find, and that's what we are doing. We are not doing the analysis of the Tata Steel, Tata Motors, or Reliance. Everybody knows who they are and what they do. But we need to find out the things like the Chaman Lal Shetia or anyone which nobody knows, and we analyze them onto our parameters. And if they fits, then we gonna buy them, irrespective of Nifty at all-time high. Because if they're gonna correct, they don't correct like Yes Bank or any other uh, UltraTech can do, but they correct. But if we have understanding that this is due to a general market conditions, then we have an opportunity to double our positions in those stocks which are fundamentally good, where we have a time horizon of at least 5 to 10 years. No, not all stocks. Not all stocks. Only those stocks on which people talk about. But if you analyze, we'll see. I'll show you afterwards how you can find that in, even though in this expensive market. But right now, actually, I'm just trying to analyze if you have your own stocks, and I'll show you how you can find out. Not all stocks are high, Satya. So that's what you need to do some work to and find out, which I'll show you just in a while. Okay, so any other company? R8. R8. R. Please give me the full name, which I could see actually. Okay, okay. Yeah, right. Right. Yeah, I understand. Right. I thought you were asking R8. Okay. Uh, Gaurav asked about Sun Pharma. So let's see Sun Pharma. Sun Pharmaceuticals. Hmm? Right. So this is Sun Pharmaceuticals, huh? Book value and the current price, the ratio of the current price with book value, it's okay. People are expecting roughly 21% growth. PEG ratio, it's a bit on the higher side. Debt to equity is okay, less than 1. And interest coverage ratio is fantastic, 17.72. So in all this, it's this just the PEG ratio, but that is still in our range, and rest of the parameters are okay. Is they have any pledge? Yes, that is the problem. Pledge percentage is 4.34. I'm interested in the companies who don't have any pledged, 0%. But let's see its EPS. So people are expecting 21%. And what is its EPS is from last three quarter, 14, 21, 18, 29. So the EPS has grown roughly from last 3 4 years, roughly 100%. So that it has a very good, fantastic EPS. And so this is actually satisfying our six conditions out of seven, right? But the peg ratio is more or less close to 1. So the current price, it's more or less its fair value. So I'm interested in this Sun Pharma on a swing basis, on a swing long or on a swing short, right? So whenever I got the Sun Pharma on intraday or on the swing basis on the lower levels, I'll try to make it long, right? But I'm not interested to have this in my portfolio. Why? Because it is approximately at its fair value. I need to have the companies in my list who are undervalued, and that's how if the market price is undervalued than the fair value, because I'm looking for the companies for my portfolio. So the natural direction of my company price follow towards the fair value. So for my portfolio, I'm just simply interested in undervalued stocks which satisfy all my conditions. But this is good because it satisfies six of my conditions. So I put them into my watch list that I'll see what I can do. If I may be in some intraday or the swing opportunities, I can go with Sun Pharma. Ashish asks for Vedanta. So let's see Vedanta. Current price to book value, it's 2. Um, okay, we can live with that. Stock P is 11%. People are expecting the 11% profit. PAG ratio is 0.7. Okay. Debt to equity, it's also okay. Means it's there. It's not like fixed. And the interest coverage ratio, it's also good. So it's okay. But you see, if by just looking at this graph on 3 years basis, you see it's more or less forming a long-term double. What it is forming? Long-term? Tell me. What is forming here and what is forming here? It's roughly around 285 and it's 329. Yes, more or less the double top, right? So look, you also needs to see the current situation of the market. In today's market, the PE value of the Nifty is 26, and the value of this PE in 26 was at 8 years ago. So we are in a very expensive market. A correction is due, but when it comes, it doesn't matter, because right now we are in such a situation that any of the news, any of the thing that can trigger a very good downfall in the market. And we, as a professional trader, we should be ready to reap that profits. Once people are screaming or crying, we should have the ability so that we can actually uh, uh, get some profits. But anyways, let's see. Is they have any pledge? No. But the promoter's stake has been decreased, but that's okay. Let's see their EPS. It's something wrong here. It can't be 0 or maybe negative EPS. So, but if I consider this to be consistent, but it doesn't have an increasing EPS, this is a worry to me. right? So although instead of satisfying most of my criteria, I don't have an increasing EPS, so I'm not interested in this company. Right, Nikhil? You got the point? Okay. Yeah, is there any other company? Okay, so now let me show you how we can find some undervalued companies. So I'll go to its home page, where it is, news feed. Okay, query builder. Okay, Petronet LNG. Petronet LNG. Current price is 231. Book value is 50. So this is an okay ratio. People are expecting roughly 20% from it. That's the reality. PAG ratio is 2. So it's a bit overvalued company at this point, right? This is the problem here. Debt to equity, it's okay. Interest coverage ratio, it's fantastic. Hmm? But the only problem is here, which is really this makes this price very expensive. But let's see if it has grown for that. EPS 9, 11, 11, 22, right? So EPS has grown fantastically, very nice. But the only problem is the current price as per its PEG value. The fair value of this company is roughly around 130, and the right now the price is 231, right? So although most of the things are good enough, but still I don't take Petronet LNG for my portfolio. You got the reason, Satyasagar? I'm gonna only take my the companies for my portfolio in which I have the confidence from inside कि yes, these companies are very good as per my fundamental analysis, right? So no for Petronet LNG. We need to find out the reason to reject, right? And we only gonna take those companies whom we can't reject, right? Is there anything else? Okay, so let's go and I'll show you how you can find out something, huh? So in this screener, on the down, you have this query builder, right? So let's put some query. Say EPS should be greater than 20. Earnings per share should be greater than 20. And say PEG ratio should be greater than 0, and PEG ratio should be less than 1. Hmm. Or we can, okay, let's see between 0 and 1 first. And debt to equity should be less than 1, and ICR, interest coverage ratio, should be greater than 3. This is most of the points na, which we are looking for. Hmm? So just and say a market price say price say current uh, say current price should be greater than the book value. Hmm? So this is all, most of our parameters are here. So run this query, 20 peg ratio. Mhm. What is the problem? Ah, right. So these are the companies which we have got, right, as per our criterias, as per our query. So let's see and analyze them. Hmm? Gujarat Automotives. This is dynamic in nature. It will, and now here also we're gonna reject. So current price, its book value, okay. Stock P is 10, PEG ratio is 0.63, okay. Debt to equity less than 1, that's okay. Interest coverage ratio greater than 3, okay. Fine. Now let's see pledge percentage, okay. And let's see the EPS. Here is the problem. You see 116, 26, 27, 23. So it has a decreasing EPS. Right? Correct? So what we gonna do with this company? Gujarat Automotives? Do we gonna take this into our portfolio? No, right? So remove this. Go to this Triton Wall. For Triton Wall, current price and the book value, it's okay. Stock P is 21. Debt to equity less than 1. EPS, although just remember one thing. You have put some queries and you have put your parameters, but after all, you need to find the companies which are satisfying your criterias, but you need to find out the reasons still to reject them. And those companies whom you can't reject at any point of time, those companies should be in your watch list for your portfolio. So here the PEG ratio is a little bit on the higher side. Debt to equity is okay. Interest coverage ratio is also okay. Let's see its EPS. 28, 72, 68, 83. So means that's fine, but from 72 to 83, it's not have that much rise in the last 3 years. And most of the time we should concentrate on the last 3 years. We can take this performance. It has done very good from 2014 to 2015, but from 2015, 2016 and 2017, it's more or less okay. It's an okay company, right? So I don't like it because there are various better companies than that, but this is okay. So I add to my watch list. Because why I am adding into my watch list? Because afterwards I will analyze them technically, on which level they are, what is their level, what was their previous level, what kind of structures they are forming, what would be the normal and the probable directions for these companies to go to reap the profits. The third is Newmax Industries. So we open the Newmax. Here, the book value and the current price, it's not okay. It's the current price is very much too far from the book value. PEG ratio is also on a higher side. Debt to equity, it's okay. Inverse coverage ratio, but look at from this perspective, still I'm not very comfortable with Newmax because of the higher PEG and also the current price and the book value. Let's see the EPS 1639.48. It has an increasing EPS. That's good, very nice. But I'm not okay here because this it's a good company, but at this price, it's more or less fairly valued, and I'm not interested in those companies who are fairly valued at this moment. Um, and on the other hand, you also needs to find out some of the very overvalued companies and wait for the market corrections. And if you see that the market is correcting, then go for those overvalued companies and short them straight away. No problem. Right. So let's analyze two more. See it. I know this is a good company. See it. Book value and the current price is okay. Stock P, say 24%. Very nice PEG ratio. Very nice. Very nice debt to equity. Very nice interest coverage ratio. This is the company I'm very much happy about. And I knew it before that it's a very good company. This company I would always like to be in my portfolio, but not right now once it corrects a bit for the longer term. Because the fair value of this CET Limited it's something around close to 8,000 rupees. And right now it is at 1,761. Right? So this is the company that we needs to be in our portfolio for sure, no doubt. Let's see the P. 69, 72, 110, 89. It has a problem here, but still I'm very much okay from 72 to 90. And what people are expecting 24%. So it's growing more than 24% as per this. And it has a spike in between that may be due to a very strong quarter or anything. So this is the company which I should like to have in my portfolio, right? Because I don't have any reason to reject it here. And then I could simply go on to the company website and then see what they do. For this, we all know, but still we need to look at the management, what is the management is doing. So Mr. Ranan Goenka is the director. Subaiya, Arnab Banerjee, Tom Thomas, Dilip Modak, Milinda Apte, Chandrasekhar. So one thing I realize here, it's not a family-run business. That it's just the propriety of any particular family, and if that something goes wrong with that family, the business goes into the vein. So looking at these management guys, I'm very happy with the management. And I know I have researched it, but once you have time, once you find out any particular good company, then go to the company website, look at the management, look at their products, look it and where they do, and go to their investors column. That is very important. And then see, you can also see some of their results. Shareholding pattern is an important thing to analyze, but this is you can also get from the money control or anything, right? So that means you needs to feel comfortable while investing in any particular company. So this is a good choice. Let's see one more, say TVS Sri Chakra. So here I go, and book value it's okay. It's a little bit on the higher side, but that should be okay. Stock P is 20%. PEG ratio it's fine. Debt to equity it's okay. Interest coverage ratio is also okay. So let's see if they have any pledge. No. So let's see their EPS. 59, 128, 238, 202. That is okay. This is just due to the strong quarter. So this is also a very good company to invest in. So let's see its website, what they do. Is the TVS Sri Chakra. What is their website? Is the TVS tiles and the TVS Sri Chakra are the same thing? Yes, indeed. So yes, so yeah, you know about us, who we are. I know this is a very good group, so I'm very much okay with it. But if you have any means conflict, so you just go onto the Google and just search TVS Shi Chakra fraud scam or any other thing to see if they have been indulging anything. Because the one company in which I have invested a lot on, that was Lycos Internet, because I believe that that's going to be a revolutionary change, and they are making those smart watches, and I really like that idea, because I think onwards the people will actually wear the smart watches only, rather than our old conventional watches what we used to have. But just by analyzing few things, and I was just reading Bloomberg, then I find out that they have a lawsuit filed in the US. And just afterwards, just after that, a month or so, the stock has plunged from 35 to odd 10 levels. So but before that, I have closed and remove all of my stocks of that company. So that you also needs to be aware of what is happening in your investments or in your invested companies. And if you see that their business model has some changes, or there is some kind of very bad thing which is happening to those companies, you just simply analyze and exit, because there are a lot many opportunities elsewhere. So we are looking for the companies, we are analyzing them fundamentally very nice and everything, and we enter them technically. But in any case, if we don't feel comfortable to be with those companies, then simply exit, because here you are not gonna marry with any particular company. You are here to make money from that company, and that's it. We shouldn't have any personal choice about the particular company, like for TVS C Chakra or for the C8, because they are in my portfolio. So always I have to be looking on all of their positive news or on the positive side. On the contrary, if the TVS C Chakra and the C8 it's in my portfolio, then I always have to look for any negativity, whether it's organization or it's in their business model or anything. Understand my point? Right? So everybody's okay with this? There is so that's how you do all of your analysis, huh? There is another side which is I just have, which is called Mojo. This is also a very good site for any of the valuation. It's marketsmojo.com, right? Here also they provide a quite good information. And here also, if I say type C8 Limited, then they give us some kind of information about Mojo analysis, what they think, that how its price has been moved, and what its moving averages are, if there is any falling investor participation, liquidity, significant yield. And they also provide some kind of things like quality, the excellent, valuation very expensive, financial trends very negative. So that's, this is their assessment, but they give certain kind of this advice, and they also give some kind of, all those things what the people are talking about. So this is another thing which you can have a look and try to find out some more information about those stocks fundamentally. This is a good website which they actually provides a lot of information about any particular stock. So first you go to deal with the screener, and then afterwards you should go and have a look on the market mozo if you have the time. So this is how we're gonna analyze our portfolio with all these our conditions, and later on you can also put some of your conditions if you like, but I don't believe in making complicated things. The simple system actually works pretty good in this market. So if we develop our simple steps, simple understanding, and we just gonna stick with those principles and our standing, that's how we make money in this market. Right, guys? So I hope this session is useful to you. And if you have any question, you can ask me now. Any question, guys? Mm-hmm. Yeah. But this session has been recorded. So this all the recordings which you have probably from tomorrow evening, and all these recordings will be staying with you till Sunday. So you can have and listen to this multiple number of times whenever you want, whenever you feel comfortable. So all of you will receive the recording links tomorrow in the evening, because any meetings will take some time to process the recordings, and then they take approximately few hours to get things recorded and translated or relayed from the server. So that's what we need, and as soon as we receive the recordings, we'll provide you the links. Of course, this session has been recorded uninterruptedly, so I don't think there should be any problem with the recordings. You will have the recordings at tomorrow evening, or maybe before that. Okay, so is there anything else, guys? Okay, so I think we have added some value more to our fundamental analysis, and that's how we keep on polishing our things, and that's how we keep on enriching ourselves with the practice and practice, and so that these things come into our subconscious minds. And I wish all of you to become a very successful and profitable trader, right? So have a good night, and I'll meet you all again on next Thursday with another topic, right? Okay. Good night, guys. Take care, huh? Bye bye. Good night. Good night. Bye bye.